If management accounting is your organization's internal GPS, then understanding its role and performance is how you check whether that GPS is actually pointing in the right direction for managers' decisions. At its core, the management accounting function exists to give decision makers information and advice across strategy, planning, control, and day-to-day operational choices inside the business. Think of the management accountant as an internal advisor who translates data into guidance that helps managers choose a strategy, build budgets, and keep actual performance aligned with those plans. Technology has changed this role, so instead of just producing routine, standard reports, management accountants now spend more time on complex analysis, strategic questions, and non-financial information. Better systems mean non-financial managers can access basic data themselves, so accountants add value through deeper insight, support for risk management, and helping integrate different kinds of information. Traditionally, management accounting information was described in 3 ways: scorekeeping to track overall performance, attention directing to flag where managers should look more closely, and problem solving to compare possible actions. Scorekeeping is about recording and summarizing results. Attention directing points out unusual trends or issues, and problem solving uses that information to weigh different options before managers decide what to do next. Managers use all this management accounting information to make decisions, plan for the future, monitor performance against goals, calculate profit and inventory values, and support processes that use resources efficiently. The aim is to enhance value for customers and other stakeholders by making sure resources are directed to activities that genuinely support the organization's objectives. Increasingly, management accountants work inside cross-functional teams, where small groups drawn from different departments and levels come together to solve problems and improve coordination. These cross-functional teams help break down traditional boundaries, support innovation, and drive new product or service development that involves marketing, operations, engineering, and finance working side by side. Within these teams, the management accountant adds value by gathering and analyzing key information, helping set goals and priorities, applying decision-making techniques, and keeping the team focused on the organization as a whole, not just one department. The main objective of the management accounting function is to provide high-quality service and information to its internal customers, the managers, so they can make sound decisions. To meet that objective, sub-objectives include making sure information is relevant to the decisions at hand, reliable and free from material error, delivered on time and communicated clearly so non-specialists can understand it. This means the management accounting function must work out what information managers want or might need, how and when they should access it, and then organize and staff the function in a way that suits the organization's nature and size. To check whether it is doing a good job, performance measures for the management accounting function should match its objectives and activities, focusing on how users judge the quality and usefulness of the information and service. Those measures can cover value for money, staff availability and responsiveness, flexibility in meeting ad hoc needs, user satisfaction ratings, report timeliness, participation in meetings, and involvement in strategic projects. Let's pull this together with a worked example. Imagine a manufacturing company that wants to strengthen how it develops new products and sets up a cross-functional team to improve that process. The team includes engineers, marketing staff, operations managers, and a management accountant who does far more than just supply cost figures to the others. This accountant collects and assesses critical financial and non-financial information about the proposed product, helps set clear financial and operational targets, and uses decision-making models to compare different design and production options. Throughout the project, they make sure decisions are taken with an organization-wide perspective, not just driven by one department's short-term interests. At the same time, the company assesses its management accounting function against those earlier objectives by asking whether the information from the accountant is relevant, reliable, timely, and clear for all team members. Managers also look at how quickly the accountant responds to ad hoc requests, whether the time spent supporting the team is good value for money given the benefits of better product design, and use internal satisfaction surveys to rate the service. This example shows the management accounting function in action. It defines information and service objectives, organizes activities to meet managers' needs, embeds accountants in cross-functional work, and then measures performance using criteria tied back to those objectives. Your takeaway is simple. For exams and for practice, always link what management accountants do with why they do it and how their performance is judged, because strong management accounting is about high-quality information that helps real decisions. If this helped, subscribe for more clear management accounting lessons.